Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management, will be joining us for the hour. And in 30 minutes, we'll review the latest results from Target. The stock is up in the pre-market as the retailer posts its best sales in 4 years. We'll discuss the growth story with Arun Sundaram, Senior Vice President at CFRA Research. And of course, we want to hear from you this morning on First Call. Reach out with your questions on sectors, and we'll have Nate answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bloomberg is reporting the Canada Pension Plan Investment Board has halted its sale of fund stakes anticipated to be worth about $1.5 billion US. Additionally, La Caisse is suspending an undertaking to sell an estimated $1.5 billion US worth of Chinese private equity assets. According to the report, potential sales were stopped as buyers offered to take the portfolios at a discount deeper than their expectations. Keyera AltaGas and CN Rail are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million. It combines Keyera's ACE Rail Terminal with CN's rail network and AltaGas's West Coast export platform. The companies say the project will strengthen Canada's energy competitiveness, expand access to global markets, and support long-term economic growth. Lowe's beat profit estimates in the first quarter on rising online sales and demand from professional contractors during spring. However, the home improvement company maintained its full-year outlook, citing macro housing market challenges. The American chain's same-store sales came in slightly below expectations. And now our top-line story. Investors are looking ahead to key results from NVIDIA later today, seen, of course, as a bellwether for the AI trade and a potential catalyst for the next move in tech. At the same time, attention is broadening beyond chip makers to sectors like industrials, which are emerging as major beneficiaries of AI through automation, productivity gains, and strong investment tailwinds. For more on this, let's bring in our guest for the hour, Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us.
It's great to be here, Roger.
All right. All eyes are on NVIDIA. Is it as important as some people think it is, or are we seeing a little bit of that importance spreading out?
I mean, it's definitely important. It's an opportunity for the market to get some reaffirmation of just how strong and where we're at in the AI cycle. And so it's an important earnings release. I would also say the bar is very high because NVIDIA has consistently beat earnings for effectively 3 years now in a row every quarter, and we're expecting 80+% growth, and both from a revenue top line perspective, but also from an earnings perspective. These are massive numbers, so there's no doubt that numbers are going to be big. It's going to be a question of whether the market likes what they hear about the outlook and whether the pace of this growth can continue. And the early evidence suggests possibly, given the amount of additional spending that some of the peers have announced over the last several weeks when earnings have been reported by a number of competitors, including the buyers of other Mag 7 companies, increasing their CapEx spending. So that should show up in the data for NVIDIA if the numbers are really good. The fact that these other companies are spending more, not less, than they announced, let's say, just 3 months ago.
And NVIDIA, their numbers, as you mentioned, are going to be massive. Is there anything that can satisfy people, or will we see a little bit of a drop off with it, you think? Because it was stagnant for a while. It kind of went sideways for about 6-8 months, and now it's like everybody else, it's caught fire again.
So the big question, I think, that's holding back NVIDIA to some extent versus some of the competitors is that there is this perception that the competitors are growing and the potential of those competitors getting a larger market share. That's the worry. And so then the multiple or the valuation that a company like NVIDIA is trading at is actually pretty reasonable. And the overhang for them has been the fact that there is an increasing competitive landscape that may be impacting them. And so a lot of the outlook is going to be predicated on how strong they think their growth pipeline looks like, and whether investors believe that the competition is starting to take some of that market share.
And broader AI, it really is now having an impact, isn't it? And presenting opportunities elsewhere.
Correct. There are plenty of opportunities elsewhere. We think there's a number of opportunities from a sector and industry perspective beyond just the technology space that's benefiting from this broad AI cycle. One of those areas is industrials, because every time one of these hyperscalers build out a new cloud database, a new data center, et cetera, they need widgets, they need nuts, they need bolts, they need materials. And this is costs a lot of money and a lot of effort, and most of those are supplied by industrial companies. On top of that, industrial companies are benefiting from things like the broader cycles that are happening in the economy, the build out of energy infrastructure as an example, the build out of other types of drivers around energy security right now, given the conflict in Iran. Defense spending is another area that benefits industrials. So there's a lot of big macro themes that are really benefiting industrials right now.
And which one do you think, is it industrials that you feel is benefiting the most, or are there other places?
There are other places. We think if you look at the broader ecosystem of AI and what that adoption will likely look like in the coming years, a number of industries and sectors are going to benefit, particularly as they start looking for ways to use AI to improve their multiples, as an example. So improving multiples includes ways to gain efficiency and productivity. And so areas of the financial sector, as an example, a sector I work in, is going to benefit from greater productivity uses of AI. Healthcare system is another area where a lot of healthcare names can benefit from efficiencies, better drug development, et cetera, from AI. So we think we're starting to see evidence that the AI isn't just about the build out of AI, that it's starting to transition into who are the true beneficiaries of AI from a longer term perspective.
And what are you looking for when it comes to industries or sectors and companies even? What are you looking for from them to see that they are embracing it as opposed to just trying to fend off AI or just kind of keep it in a place? But I mean, I think the reality is it's going to end up in everything.
I think you're right. It's going to end up in a lot of places, but companies are going to have to embrace it. And I know there's some impacts to workforce examples that will have a problem, but at the end of the day, we are looking at a massive secular shift here that drivers of productivity and drivers of our GDP growth globally is going to be predicated on advancements in technology productivity. And it's not just AI itself, it's things like robotics and other areas that feed into productivity. And so company margins are actually likely to increase because companies are going to be more efficient by using these types of productivity tools. And so companies will have to deal with the challenge of balancing the workforce needs relative to these technology needs and the spend of that. We're already seeing that anecdotally in some of the evidence, but it is a real secular shift, both from the perspective of the dollars involved, but also the impact to workforces and how companies engage on a daily basis.
And we're hearing that. I just heard a number bandied about today that in the U.S. it could be 100 million jobs affected by AI, which is an insane amount.
It is the same amount, but at the same time, new jobs will be created, and there is abilities to retrain workers, and there is abilities to find new opportunities for workers. But there's an effort that needs to go into that, and governments need to be involved, as well as companies need to be involved to make sure that there is placement for those types of workers that may be displaced by AI through new jobs and new opportunities that will live in the new world.
And is this good? Do you feel this could be one of those situations where we'll see a massive upsurge suddenly, and then it'll plateau because it'll have been implemented, and then we'll be looking at how do we go to the next level from there?
I think we're still in the early innings. The reality is any of the recent language models that are coming out with AI, they're early innings, and the advancements that we see in technology will be continuous. Just think about how memory and chip stocks over the last several decades have advanced by speed, by accuracy, things like that. I think we're in the very early innings when it comes to the advancements that we'll see in AI. So the plateau, while it could happen at some stage, is quite a ways in the future in our view, but it's not going to be a clean line. The reality is there's going to be real winners and there's going to be real losers when it comes to the rollout of AI going forward. And I mean, the market's starting to decipher that. They're seeing reactions in the market where people announce good news around AI, not all of them are reacted positively at this stage, where it was a year ago. So the winners and losers are starting to be identified, and I think that's one of the key differentiators in the more recent quarter than it has been over the last couple of years.
Okay, we have to take a break on that note there, Nate, but we'll be back. We'll take a look at the markets before the bell and discuss why traditional diversification of stocks and bonds is now less reliable considering inflationary pressures and geopolitical tensions. See how things are shaping up on the markets right now. We'll start with U.S. futures, and they are trending positive yesterday. There was kind of a midday rally yesterday, but it couldn't hold. And so today, we'll see what happens. A little bit of Tina. There is no alternative. The dynamic continues to support equities despite the rising yield. So we'll see what happens with this. But right now, the NASDAQ is up right now at 0.68 and the S&P 500 by 0.37. Over in Asia, it was an off day across the board there. You can see the Nikkei down by 1.23. The Hang Seng also down 0.57. The CSI 300 pretty much a wash at this point. And over to Europe now, and some optimism there. You can see all of them in the green. The FTSE by 0.1% and the CAC 40 by 0.55. German DAX up by 0.43. And some of the news there, the EU finalized the text of its long-delayed agreement with the U.S. overnight, removing a significant headwind ahead of Trump's threatened July 4th tariff deadline. The TSX, what did it do yesterday? Down again, well below 34,000, and it was a mix on who led it and what happened to it. There were some gainers, but for the most part, it was dragged down by materials, up by almost 4%. Again, some of the winners and losers from yesterday. Go Easy, up 8.67%. It's on a roller coaster. Strathcona Resources, up by 5.8%. America's Gold and Silver taking a hit, though, down 13.25% roughly. And Aya Gold and Silver off by 14.5%. And so what are the metals doing? Gold is off a quarter point at just below 4,500. Silver, though, continues a little bit of a rally. It's been in the mid-70s for a little while, up by 0.88. And copper also going strong right now, up a half point at 6.25. And taking a look at Western Canadian Select from yesterday, this shows you how the things are unfolding in the Middle East. A lot of uncertainty. It was down a half point at 83.32. And today, WTI is also down. Look at that, 2.25 right now. At 101.77, and it continues to drop the last few days. All right, rising rates, sticky inflation, global shifts, all challenging one of investing's most trusted strategies, stock bond diversification. We're back now with Nate Tuff from Manulife Investment Management to see where investors should increase their exposure. Nate, Tina, I mean, is that applying right now?
I think it is applying. You're absolutely right. The challenges are real when it comes to how we build portfolios these days for all investors. We have seen more evidence that bonds and stocks are not reacting like they historically have. And because of that reason, we need to be more thoughtful in how we build resilient portfolios for clients. And what do I mean by that? Typically, when bond prices go up and yields are falling, that's an environment where stocks are doing fairly well. And the opposite is true when bond yields are going up. So there's dynamics in the marketplace right now that aren't acting normal. And 2022 is a classic example of that, where both your fixed income and your equities disappointed at the same time. And our view is that we're not giving up on fixed income. Fixed income is an important part of every investor's toolkit. But the reality is we need to be much more thoughtful about how we're using that fixed income and the duration or the longevity of that fixed income that we're using. And also we need to think about other diversifiers when it comes to what should be in your portfolio to offset some of these challenges between the correlations between equities and fixed income.
Okay, so how are you using bonds then? What are you doing with them?
So from a bond perspective, because they are so important to a portfolio as a stabilizer, what we're advocating for in portfolios is to be underweight duration. So what does that mean? That means effectively you want to be overweight to part of the yield curve that's shorter duration. So the 1 to kind of 5-year time frame or up to the belly of the curve, perhaps as long as 10 years. But beyond 10 years of maturity, we're much more skeptical. And the reason for that is we are seeing globally bond yields rising. And when bond yields rise, bond prices fall. And in that environment, particularly historically over the last 30 years, we see some large forces in the market that have kept yields lower. One of those forces is Japan, believe it or not, because the world is very interconnected from a bond perspective. So now that yields are rising for the first time in decades in Japan, that is no longer serving as a floor for global bond yields. And because of that reason, we are seeing a lot of upward pressure or increases in term premium, as we call that, on the longer end of the yield curve, which is causing the problems around bond prices not acting as well as they need to, particularly in risk-off environments.
And is this a one-off? Do you think the situation we're sitting in right now, is it a one-off, or is this maybe the new normal?
I don't think it's a one-off. Keep in mind, we went through basically a 30-year period from the early 1980s all the way until 2022, where bond yields pretty much went down from a yield perspective structurally. I think we're in an environment for the next several years or decades even that yields will traffic higher. And the reason for that is we're seeing massive increases in fiscal spending globally. We're seeing higher levels of inflation volatility as well as structural inflation. And for those reasons, we think term premium needs to gravitate upward. And so the structural shift is that it won't be a straight line, but we think the episodes of yields increasing are likely going to be more frequent going forward, and the overall structure of yield will likely rise in the coming years, which means we're in a very different secular environment for bonds than we were in the 80s, 90s, and early 2000s.
And how do you play that long term, and where do you, any idea where you see them ending up for a level?
So, that's a great question. Where does I'll use the U.S. 10-year, and the Canadian 10-year is very highly correlated with it from a direction perspective. But when you think about where the 10-year could end up, we could be talking about numbers at some stage in the next decade or two where we're talking about a 7 handle or an 8 handle over time. It's not going to get there in a straight line, but we're a long ways away from that. So if term premium is truly repriced appropriately, given the amount of fiscal debt that's out in the marketplace, as well as some of this volatility structurally that's existing through kind of reorganization of supply chains, we could see structurally higher yields in the decades to come. And again, it will probably be more gradual and not overly impactful, but at the same time, it is problematic for the pricing of those bonds in the next, let's say, several years, if not decades.
And I just want to go back for a second. You mentioned diversifiers. What are you looking at? How are you treating them?
So beyond fixed income, and there's a lot of opportunities here, I think, for clients to look at, we believe that a lot of clients are underweight parts of the real asset market. What do I mean by real assets? I'm talking about things like infrastructure assets, real estate assets, also things in the commodity space, energy, gold, silver. Despite the pullback that we've seen in gold and silver recently, we think there's some real structural tailwinds that could benefit those assets in the coming years. Infrastructure is a highly in-demand area. We talked about the build out of AI earlier, but AI infrastructure and the tangible assets that support AI is real high demand but limited supply. So the value of some of these commodities and infrastructure, in our view, is fairly early inning cycles for potential upside, and they do serve as a good replacement for some of your longer duration fixed income in a portfolio.
Okay, we're going to get a little more into that coming up after the break with Nate. We're going to discuss some investment themes, including a potential strategic supercycle in commodities. Time to see what's on the radar for Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. And Nate, commodities, you think they're entering a strategic supercycle?
Yeah, I think there's certainly signs that we're entering a period of time here where we could see some meaningful upside in commodities. I mean broad-based commodities, not just oil prices that we've seen more recently. But when you look at some of the underlying trends, we mentioned some a bit earlier, but inflation as an example. Inflation, while I don't believe that we're going to see massively higher structural inflation, but we could see a 0.5% average higher inflation in the coming decade versus the last decade. That is meaningful over time, particularly when you think about saving for retirement over 20 30, 40, 50 years. But the other dynamic, as we mentioned, is this idea that governments, not just the US government, not just Canada, not just Europe, all governments are spending more money to become more inward facing. And that includes defense spending and things like that. And so because of that reason, we're seeing evidence that there's a need for countries to become more self-sufficient when it comes to commodities. And the Iran conflict just adds to that need, right? There's an energy shock happening right now. So the ramifications of that are many countries are going to be looking for ways to increase stockpiles of energy. We're also seeing it beyond energy. We're seeing it in rare earth metals, as an example. We're also seeing the buying of gold from central banks and other buyers globally. So there's a lot of evidence that there's underlying drivers of some of these commodities, both structural but also driven by policy, that have the early signs of having a broader cycle where we see upside in a number of commodities in the coming years.
Any concern with political parties, governments change, the geopolitical shock like we're seeing with Iran? Once it's over, everybody just kind of naturally resorts to the easiest way, which would be getting oil out through the Strait of Hormuz again. Any concerns about that?
That's absolutely a concern from a tactical perspective. No doubt, if we get a resolution in Iran, we will see some downside in oil prices pretty quickly and pretty immediately. And I do think oil in particular, because there are ways to innovate and ways to use oil more efficiently, there's also other sources of oil beyond just Iran, that oil prices may not actually be the epicenter of some of this commodity increase. I think they will participate in the upside of commodities over the course of time. But at the same time, we've already seen a large reset in oil prices because of Iran. But elsewhere, you look at some of the metals complexes, as an example. Copper is very difficult to get out of the ground, and the demand for copper just keeps going up. AI spending, defense spending, build out of infrastructure related to energy, et cetera. There's a lot of different commodities beyond just the oil commodity that can benefit from some of these secular themes. So I wouldn't place too much emphasis on just one individual commodity, but the broader complex of commodity over the course of time, we think will gravitate upward given the underlying drivers that we're seeing across the globe for both the structural needs for these commodities, but also some of the policy changes that will likely come from governments.
All right, let's talk about quality stocks, and they're still quality stocks to you.
So that's a great question. One of the areas of the market that I think a lot of people have been disappointed by is there's a lot of great companies out there who have delivered very good, consistent, stable earnings, but they're not doing very well from a performance perspective because the market has been so focused on the momentum names, the AI names, the big theme names that are winners, that are growing at extraordinary levels right now. But those extraordinary levels of growth can't continue indefinitely. We do think there will be some evidence of investors starting to return to more of these stable, high-quality earners, parts of the healthcare industry, even the software names, which are steady Eddie growers over the course of time. We think people will start to gravitate back towards them. And we're already seeing a little bit of that evidence over the last couple of weeks. But there's also areas in the consumer staple space, et cetera, and utilities where we have these consistent earners the market has not been rewarding, particularly over the last couple of years. But I think when you start to see markets get a little frothy and we start to see the rollover of these very high earnings eventually by some of these high flyer names, we will see investors gravitate back for some of these higher quality companies. I think it's an opportune time to start rebalancing your portfolio a bit by selling some of your winners in the big tech names and redeploying those on the margin to some of these higher consistent earners in the quality space.
And now we had started to see, it seemed like there was a bit of a rotation away from tech, and then all of a sudden February and March happened and April, and that's all gone out the window again.
I think that's the power of the earnings that we're seeing. I mean, it's unbelievable where we see the secular driver here on earnings. It's impossible for the U.S. S&P 500 as an example to continue to grow at 30+% type of earnings. It's just not possible. But in the short term, that is what's happening. We're seeing massive earnings growth. So it's not a surprise to me that investors keep trafficking back to some of these big winners. But at the same time, the valuations as well as the sustainability of that earnings will have to come into question eventually. I don't think we're there yet. I do think there's still some run room. And I'm not saying you should abandon overweights and positions outright in these names, but because the size of these names in your portfolio have likely increased, I think it is an opportunity to take some of those chips off the table and redeploy them back to quality. This isn't about giving up on AI. AI is a real secular theme, and there's going to be a lot of winners, and there are going to be some losers. But you want to have some exposure there. But what I'm saying is there's other opportunities to diversify back towards some of these quality names for that inevitable period of time where we see some downside or more volatile equity markets.
All right, we have to wrap it up there, Nate. You mentioned software. We didn't get as much into it as we would have liked, but you still think there's opportunities in software, but we'll have to wrap it up there. Still ahead, Target is showing signs of a turnaround after posting its best same-store sales growth in 4 years. We'll break down the full results after the break. And our phone lines, of course, will open soon for our first call segment. Reach out at 1-855-326-6266. You can also email us, firstcall@bellmedia.ca. Keyera, AltaGas, and CN Rail are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million. It combines Keyera's ACE Rail Terminal with CN's rail network and AltaGas's West Coast export platform. The companies say the project will strengthen Canada's energy competitiveness, expand access to global markets, and support long-term economic growth. Shares of TJX are up in the pre-market. The retail chain raised its sales and profit outlook for the full year as cautious shoppers spend on lower-priced goods of the company's discount chains. The company's full-year fiscal 2027 outlook now assumes a higher cost of fuel will remain in place for the rest of the year and will be unfavorable to profit. Target saw its best same-stores growth in 4 years, coming 3 times the gains analysts were expecting. The retail chain is also raising its annual revenue guidance. The latest quarter saw the American company freshen up merchandise and stores and integrate technology operations. Target also beat profit estimates with health and wellness and baby and toys coming in strong. Quick look at the U.S. futures, and seems to be a bounce back from yesterday, especially amongst tech. You can see that the Nasdaq's up by 0.78 and the S&P 500 up by about 0.5 point. Target is in focus after posting first quarter results that topped expectations, with the retailer reporting its best comparable sales growth in 4 years. The company also raised its full year sales outlook as it pushes a new turnaround strategy. Joining us now to discuss it is Arun Sundaram, Senior Vice President at CFRA Research. Arun, thank you very much for joining us. Can we say Target is back?
I think it's too early to declare victory, but yeah, clearly the turnaround is progressing well for Target. Solid top line this quarter, also very solid bottom line this quarter. You saw margins also expand as well. But let's see if they can replicate this, because Target has had good quarters in the past. But one issue with them is that there's been some execution issues. So let's see if they can replicate this quarter going forward.
Arun, what are some of the reasons why Target seems to be in the early innings of a turnaround here? Are you seeing evidence that some of the new strategy efforts that they're working on are actually starting to flow through to these earnings numbers?
Yeah, I think it's early stages, but right now Target is really trying to establish its merchandising authority. I think over the last 3-4 years, it's safe to say that Target probably underinvested in its business. They kind of lost that Target magic that everyone is trying to, or what they were known for in the past. But now they're trying to introduce more new products into their store. They're refreshing some of their assortment. Even in food and beverage, they're trying to introduce more private label, newer products. In areas like apparel, they're now really trying to focus on women's apparel, because that's a key category for them. So they're trying to increase the assortment, like in areas like denim, women's tanks, tees, things like that. And I think that's showing up early in these results. But again, it's I think there's a long way to go before Target kind of returns back to its historical standard. Because if you look at their margins today, Target's operating margins this quarter were about 4.5%. That was up 80 basis points from last year, but historically Target's operating margins used to be around 6 to 7%. So there's still a ways to go, I think, before Target returns to its historical financial profile. But again, I think Q1 results show that the turnaround is progressing well.
And is that ambitious or is it manageable?
I think it is manageable because if the difference between Target and a lot of some of its retail peers is that Target sells a lot more discretionary items in its store, which can be very cyclical. But a lot of these discretionary items carry higher margins. Think especially categories like home and apparel. They carry higher margins than selling groceries, for example. So I think over time we will see Target's margins expand. And then I think probably most importantly is Target is also growing some of these alternative revenue streams, things like advertising revenue. They're also having subscription revenue with they have a membership model as well called Target Circle 360. They also have a third-party marketplace as well, where they're introducing more third-party sellers and things like that. These are high-margin revenue streams, especially advertising. And so if these alternative revenue streams continue to grow, this quarter their alternative revenue business grew about 25% year over year, and that's good for overall margins as well. So I think over time we could see Target go back to that historical 6 to 7% margin, but it'll take quarters and years before that happens. It won't happen overnight.
And you mentioned margins. I mean, the retail space can be very brutal because the margins are just so slim in general. Do you think Target has the potential to hit the right balance between the haves and the have-nots in the consumer market right now? We all talk about how the consumer is under stress, and yet discretionary is kind of their focus, which tends to be the thing that people give up on the first when they have to sacrifice something. Are they hitting that balance between having the necessities to get people in the door while still trying to sell that discretionary aspect?
Yeah, you're right. I mean, Target is clearly more of a discretionary retailer than some of its peers like Walmart. That's one of the reasons why Target has been trying to focus on increasing its exposure in everyday essentials, food and beverage, because that's the traffic driver. Many people don't go into a Target store necessarily to buy groceries. They go in there to buy some discretionary item, and then they might supplement that purchase with some groceries. Whereas the average Walmart shopper, they're probably going into that store to buy groceries, and then they're like, hey, maybe I buy some clothes, some other discretionary items. So there's differences in shopping habits between Target and Walmart, for example. But right now Target is really trying to increase exposure to food and beverage, everyday essentials. They're actually in their stores, Target stores. They're trying to expand the amount of selling space for their food and beverage items because that's the traffic driver. And I think again that's showing early results this quarter, but let's see if that can continue, because Target is also because of this new strategy, they're also remodeling a lot of their stores because it takes a lot of effort to kind of revamp these stores for this new strategy. So like I said, this turnaround, it's early days, but it's going to take quarters and years before I think we can declare victory.
And the new CEO, what kind of an impact is he having?
Yeah, so far it's been pretty good. The Target, not just their CEO, but really much of their executive team is brand new. They have a new merchandising officer. Yesterday, they also just announced a new supply chain officer, and which I think is a big hire because this individual is coming from Walmart. Spent about 17, 18 years at Walmart, and I think that's a good sign because historically in the past, Target's supply chain has also been kind of an area of weakness. Like I said, they want to introduce new products into their store, but if you have a weak supply chain and it's taking too long to get these products into your store, then that's no good. So I think improving the supply chain will help various aspects of their business as well. So. Let's see. Again, they have a new management team. Early days of a turnaround. The stock has also done pretty well over the last year. I think there's more optimism, investor optimism at Target today than there was a year ago. The stock is also re-rated higher. It's trading at higher multiples than it was about a year ago. And again, there's a lot of optimism on this turnaround strategy. But turnarounds are often not linear. It takes time. There could be some hiccups along the way. Target is, like I said, more of a discretionary retailer. There could have been, even this past quarter, there could have been some one-off items that helped their business, like higher tax refunds, for example. And right now, consumer sentiment is like at an all-time low in the United States. So I think there's still a lot of risk remaining for the rest of the year. But obviously Q1 was a solid start.
Okay, we have to wrap it up there, Arun, but thank you very much for joining us.
Thank you.
Arun Sundaram is Senior Vice President at CFRA Research. Still ahead, why market drops don't last as long as they used to and what's helping stocks bounce back faster. We'll have more after the break. And our phone lines are open. Nate will be taking your questions on sectors. Call us at 1-855-326-6266. Email us, first call at bellmedia.ca. The structure of equity markets has evolved over the past decade with the rise of passive investing and a greater share of assets held by wealthier investors. We're back now with Nate Tuft from Manulife Investment Management to see how these changes are influencing how markets respond to stress. And Nate, what's the key thing you notice? What has changed when it comes to stress on the markets?
Well, the obvious thing that's changed is if you look back in history, corrections are frequent. They happen all the time. But the reality is more recently, over the last decade or so, and increasingly so, the rebounds that we're seeing in the markets become much quicker and much faster. I'll just use the Iran conflict as an example. We had several days and maybe in a couple of weeks where we had downside pressure, but the rebound has been massively strong to see all-time highs when it comes to many of the equity markets around the globe. And there's really two big forces that are driving that in our view. One is the fact that we do have a lot of dollars now trafficking into index products. And these are mechanical buyers because they're constantly there. Even during the biggest crisis that we've had in the last decade, COVID crisis, net flows into index products and passive products did not go negative. So you had this natural flow of capital coming into the markets on a regular cadence because of ETFs and indexes. And the other big theme is wealthy investors. We often talk about inequality as a social issue, and it is a social issue. But when you think about the impact to market structure, wealthy concentration is helping the markets. Because keep in mind, wealthy investors have a lot more assets than they have liabilities. They have a much lower need for liquidity on a daily basis. And they're arguably underinvested because they don't have their money all in at work at the same time. So they're able to come into the market very quickly because they don't need the liquidity. They have the assets to put to work. And so those investors return to the market much more quicker, and this is what causes the market to have more upside and the rebounds to be much more dramatic than we witnessed over the last several decades.
And then from the retail investor side?
And this is the other fascinating dynamic. We used to, on the institutional side over the last many decades, call the retail investors sometimes dumb money. And the reason for that was because historically, retail investors often were late to the game. They came into the market when the markets were already hitting new highs. But the more recent phenomenon is the retail investor has been the smart investor. They're the investor that have been buying the dips on a routine basis, and that behavior change has actually been quite dramatic. And so retail investors are now tending to lead the markets. They're constantly coming in and buying the markets after a drawdown. So the buy the dip mentality is very much alive, and the behavior of retail investors has shifted over the last several decades.
And so overall, is this all a good thing, a neutral thing, a bad thing?
I think it depends on your perspective. From the perspective of wanting wealth creation over time and to mitigate downside risk in markets, I think it's a positive because you have these natural buyers coming to the table to participate in the capital markets system. Capital markets were not always available to everyone if you go back 50 years. And now it's readily available to everyone. So dollars are closer to the market and much more able to be put to work very quickly and efficiently and at a very low cost. So you can get stock trades now effectively for free in some geographies. And so I think that's a positive. The negative is sometimes the market now ignores fundamentals. And so good companies don't always win when it comes to stock performance. And sometimes bad companies that are just high beta and just kind of, meme stocks, example, win because of sentiment and technical trading. And so the ignoring of fundamentals, I would say, is a negative for the market because good companies should be rewarded, and they're not always being rewarded quickly anymore, and particularly things like quality stocks, as an example, which has been an underperformer, even though they're probably deserving to win in some regards because they are the consistent earners over time.
All right, we'll wrap it up there, Nate. But still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including an upgrade for Franco-Nevada. Let's take a look at some of the notable analyst calls and recommendations. TD Securities has upgraded the precious metals royalty giant Franco-Nevada from hold to buy. The upgrade comes after a strong wave of new stream investments and major progress in Panama. Analysts project that the idled Cobre Panama mine could restart within the next 6 months, which would immediately restore a major revenue engine for the company. Franco-Nevada has always been highly aggressive, deploying more than $3.3 billion in capital over the last 2 years. Yet even with that heavy spending, they maintain a pristine balance sheet with $4.1 billion in financial capacity for future deals. BMO Capital has initiated coverage on Lumina Metals with an outperform and a price target of $17. Lumina Metals has recently excelled by tripling its IPO target and raising more than $406 million. Stifel Canada has reinstated coverage of Calian Group with a buy rating and a $100 price target, citing record Q2 results and a strong Canadian defense spending outlook. The company reported an 18% year-over-year revenue increase and a 60% surge in adjusted EBITDA. Well, as the snowbirds prepare for their farewell season, the city's tourism sector is bracing for a major blow once the jets are grounded. CTV's Alison Bamford has more on the industry that is synonymous with the squadron.
The legendary Snowbird jet, an emblem of Canadian pride and an iconic symbol that puts Moose Jaw on the map.
We're road tripping back from Kingston. Me and my girlfriend just graduated, and we're stopping by all the big things.
Sam O'Brien first saw the aerobatic team perform in BC when he was just a kid.
Bit of a big thing, you know, they cause a stir. Got to see the snowbirds when they're in town, even in BC.
Those are the types of experiences many say they will miss while the squadron is grounded after this season. It's a hard pill to swallow for the city's tourism sector.
Financially, it's not good and it will hurt.
This restaurant owner says sales increase fivefold when the Snowbirds perform during Moose Jaw's air show, one of the biggest summer attractions.
People come from all over Canada, even the northern parts of the U.S. to watch these.
You can find signs of the iconic Tudor jets across the city of Moose Jaw, including here at the Western Development Museum, where tens of thousands of people visit every year.
Tourism in Moose Jaw is all about experiences, and we're storytellers, and it's about our culture and our heritage, and the snowbirds are all entwined into that.
Tourism Moose Jaw says it understands the need to replace the aging fleet. For now, they're looking forward to the tourists this summer's air show will bring.
I think it's going to be huge.
Now that they know it will be the Tudor jets' last. Alison Bamford, CTV News, Moose Jaw, Saskatchewan.
And when we come back, Nate Tuff will take your questions on First Call. All right, time for First Call, first email, and that one is from Paul. And Paul says, I hold a couple of utility stocks. What is your outlook on the sector? Nate?
Yeah, the utility sector is an interesting sector right now. There's some big secular positives, such as the investment required to get new energy on board, driven by the AI cycle, as an example. So we are seeing companies deploy new assets and potentially increase prices. And so in geographies and countries and states where price increases can pass through without government, a significant government regulation, we do think there's an upside in the utility sector. At the same time, the challenge right now is utilities generally don't like higher interest rates, and yields have been rising globally. So year to date, utilities have been kind of an okay performer, but not a great performer, as they balance this idea of the benefits driven by the need for more energy globally and power, with the idea that rates and the cost of building out that infrastructure is going up because of higher interest rates. So net, we think the secular theme wins out, as we are somewhat favorable as a longer-term play, owning some utility exposure in portfolios.
All right, let's get another email in. This one is from John. I'm inquiring about ServiceNow and if they can be a standout again in the roughed-up software sector.
Yeah, that's a great question. The roughed up software sector has been a challenge. We are seeing some light at the end of the tunnel right now with some rebound in the early innings, but there are a lot of questions around the sustainability of some of these names. My general view is there'll be winners and losers. And the software names that have the true data that they own it themselves and are heavily embedded into the infrastructure of big corporations, ServiceNow kind of sits in the middle of that. Unfortunately, they don't really own the data, so companies can do what they want with that data and create their own AI tools and or hire another software company. But at the same time, ServiceNow is very embedded into the ecosystems of almost every major company in the world. So that reoccurring revenue is real. So it's not a question of whether they can drive good earnings. It's a question of can they survive long term that the market is grappling with right now. We think there's opportunities here in the short term, just driven by the power of the earnings and the drawback that we've seen in the prices of some of these stocks. But longer term, there will be real winners and losers, and I'm not quite sure where the ServiceNow will land on that front.
All right, Nate, we've got to wrap it up there, but thank you, as always, for joining us here on The Street.
Thank you for having me.
Okay, that was Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. And coming up next is the Open. Trading gets underway a little more than 30 minutes from now. Have yourself a great day.